If you are a business owner, a CEO, or an investor running a company on IFRS, the way you measure and present your profit has just changed forever. The International Accounting Standards Board has officially retired IAS 1 and has now replaced it with the brand new framework for financial reporting presentation, IFRS 18. In this video, I will be going through what are the key changes in IFRS 18 and what you as a business owner, even if you do not report under a mandatory auditing and reporting disclosure standards, what you need to be aware of when it comes to the update in the way your financials are being prepared. Now, IFRS 18 mainly deals with the presentation of financial statements, and the new change is fundamentally in the way that the statement of profit or loss has to be presented. There has been a fundamental change. Now, this is not just a minor footnote update whereby you just have to add one or two lines to your notes to the accounts and you're done. This is more complicated than that. This is a complete structural overhaul of your income statement. For many decades, companies have always maintained massive flexibility on how they defined their operating profit, and companies could cherry pick what went into the operating numbers in order to make the core business look healthy to the shareholders and the users of financial statements, when maybe behind the curtains of the polished financial statements, things were not as they seem. Now, those days are officially over. Starting reporting periods after January 2027, IFRS 18 is in effect. If you do not adjust your financial reporting structure right now, your next financial statement could look wildly different, and it could potentially tank your business valuation or could even trigger a technical breach of your bank covenants. In this video, I'm going to break down the three massive shifts under IFRS 18 and the exact trap many business owners are falling into. Later on, I will also cover how we automate this transition from our accounting firm. Now let's look at the first major change, which is, as I mentioned, the standardization of the income statement. Under the old rules, there was no single mandatory definition of operating profit. If you wanted to slide certain unusual expenses down into finance costs or general overheads to keep your operating profit clean, you could have gotten away with it. But now, IFRS 18 completely sanitizes this by forcing every single business into three strict categories, every single business activity into three strict categories that affect the statement of profit or loss. Think of this as a mandatory sorting hat that for every single dollar of income and expense that passes through your books. Now, the mandatory restructure of the profit and loss statement is as follows. The flexibility that was once permitted by IAS 1 is now eliminated. Every income and expense must be sorted, as I mentioned, into three strict categories. The first is the operating category. This functions as the default home for core business activities. If an item does not explicitly qualify for investing or financing, then it must be classified here. The investing category. This isolates income and expenses generated from assets that yield returns independently of the core business. What used to happen prior to this update was that returns generated from, let's say, investing in short-term marketable securities was also mixed in with operating profit, and it could make the figures look better than they are. Now there is clear distinction. Third, you have the financing category. This isolates the pure cost of raising equity, which is the cost of equity and the cost of debt, from the other costs in the P&L. This includes things such as the interest on bank loans and interest expenses on lease liabilities that are accounted under IFRS 16 lease accounting. Now, why does this matter? Because by forcing a strict definition of operating profit, investors can now do a brutal apples to apples comparison. There is a like for like comparison between the business and its competition. If the operating profit was previously inflated by clever classification, IFRS 18 will strip that mask right off. Now let's look at the P&L sample so you can understand what is exactly happening in terms of changes. You can see there is no categorization of operating, investing, and financing in the profit and loss statement prepared as per IAS 1. These subtotals are now mandatory, which I will be covering next. Other mandatory subtotals that are there within the statement of profit or loss. In order to prevent management from artificially inflating their operating margin or hiding volatility, companies must now display two newly defined subtotals on the face of their income statement, which is the operating profit or loss and profit or loss before financing and income taxes. Now, the operating profit or loss is a consistent, standardized starting point for investor analysis across all industries. This helps financial analysts analyze different companies in, for example, one industry without the issue of lack of comparability. It helps standardize comparison when applying financial ratios. And profit or loss before finance and income taxes. This clearly separates core operational earnings from capital structure costs and tax environments. Now, management performance measures. These are measures that the management comes up with in order to provide the users of the financials and the annual report into a look into their mind. It acts as a door that unlocks the management's perspective on how they view the business. Because maybe as per the International Financial Reporting Standards, IFRS profit, something is low, but maybe this was low due to one-off costs, such as one-off business restructuring costs. This one-off item is removed from the IFRS profit and is now communicated as adjusted profit. Now, to make the point what I mentioned before clearer, previously, prior to IFRS 18, companies could do this and not reconcile it back to adjusted profit. Back to the IFRS profit. They could just present it, but now IFRS 18 requires companies to reconcile it. Audited reconciliation table that shows exactly how the custom number links back to the official IFRS total. And here is a real kicker that catches everyone off guard. You must explicitly disclose the exact, listen closely, the exact tax effect and the impact of non-controlling interests, if they have subsidiary, for every single adjustment that is being made. Because when a non-controlling interest exists, they have a right to get accurate information from you, the parent company. So you must show the NCI effect, the non-controlling interest effect as well, when showing the adjusted figures. Management can no longer cherry pick numbers. If there has been an adjustment that has been made for loss, this same adjustment must be made for windfall gain. If there is, you cannot just take out one-off losses but keep in one-off gains. That's basically what it's trying to communicate, because this will force absolute transparency and there is balance. One-off gains are removed and one-off losses are also removed.